Simon Property Stock, ticker symbol SPG. Investors love the stock because of the 6% dividend yield. So is this the best dividend stock to buy right now? SPG stock is down almost 28% year to date, which is quite a lot, especially if you compare it to the overall market, which is down 20% year to date. Simon Property missed FFO in the most recent quarter, which is one of the most important numbers for REITs, but did beat on revenue by 42 million. But does that mean that SPG stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Simon Property does. The most recent earnings, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does SPG do? Simon Property Group is an American real estate investment trust that invests in shopping malls, outlet centers and community lifestyle centers. It's the largest owner of shopping malls in the United States. If we dive in the latest quarterly report, we see that net income attributable to stockholders was 539 million versus 679 million prior year. So this doesn't start very good, to be honest. Comparable funds from operation, or FFO, was 1.1 billion, or $2.97 per diluted share, compared to 1.09 billion, or $2.92 per diluted share. So a small increase there. The domestic property net income, NOI, increased 2.3% and portfolio NOI increased 3.2% year over year. A thing that I don't like here is the fact that occupancy rate was at 94.5% in the recent report. I prefer this number to be around 96 to 98 depending on the type of REIT. The good part is that it's increasing year over year. The 2022 guidance is expected to be within a range of 6.16 on the low side to 6.21 on the high side. FFO is expected to be in a range of 11.83 to 11.88. The comparable FFO range represents an increase of $0.12 and $0.26 per diluted share at the midpoint when compared to the ranges provided on the August 1, 2022 and February 7, 2022 respectively. Another thing to keep your eye on is the dividend payout ratio. REITs use FFO to pay out the dividend and usually have a payout ratio around 75%. In 2021 we see FFO of 2.92 and dividends of 1.5, meaning 51% payout ratio. Dividends in 2022 were 1.75 and FFO was 2.97, which gives us a payout ratio of 59%. So it's still looking good, but when dividends are growing at a higher pace than the FFO, you might run into problems in the future. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Simon Property is a 38 billion market cap company with PE ratio of 19.5. But since this is a REIT, I don't want to focus on the PE ratio and use a price to FFO instead to see its valuation. Price to FFO is at 11.42, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for SPG, so make sure to watch until the end, since price to FFO is only telling a small part of the full story here. Revenue is at 5.2 billion and in this graph we see that it's going up and down a lot historically. And yes, in 2022 revenue went down because shopping malls were partly closed because of the lockdown periods. But you also gotta think about the future. After lockdown periods, revenue started to recover, but it's at the same level as 2015 right now, which concerns me a bit. It's not recovering that fast. Net income is at 1.97 billion, which gives us a profit margin of 37.7%, which is in line with the 5-year average, so that's looking quite good. EPS is going up and down quite a lot, which is also very common for a REIT. This is definitely a figure to keep your eye on. Price to free cash flow is at 11.81, so let's call it 12. To me, this looks all good. Analysts are expect EPS to increase in low single digits, which kinda surprised me. but revenue is expected to stay almost flat in the coming years, which concerns me a lot. Return on assets is sitting at 8.3%, which is pretty good for a REIT. And it's the same story with the return on equity. Return on invested capital, the most important number here, is at 7.8%, which is also quite good for a REIT. But the thing that I don't like here is the fact that it's below the 5-year average. Current ratio is at 0.98, which is also pretty good. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. Another thing to keep your eye on is the total debt and the total cash. I prefer companies who can pay down at least a third of the total debt with the total cash. Right now, total cash is at 600 million and operating cash flow is at 3.7 billion. Total debt is at 25 billion, meaning they can't pay down a big chunk of their total debt. The thing is that it's pretty common for REITs, since they use debt to grow the business. So it's very important that free cash flow is growing, since this is used to pay down debt, do acquisitions, buy back shares and all other things. In this graph we see that free cash flow was increasing quite nice and steady, especially for a REIT. However, it started to decrease in 2019, so before the lockdown periods. Then the lockdown periods hit, and of course things go down. But after things cool down, the free cash flow is increasing again, so this comforts me a lot. If we check the shares outstanding, we see that it's going up quite a lot historically, which is also pretty common for a REIT since they issue new shares to raise capital to grow the business. However, they started to buy back shares in the most recent quarters. This will make it easier to maintain the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 6.2%, which is of course very high. Annual payout is at $7.2, and earlier in this video we saw the payout ratio is at roughly 60%, which is pretty common for a REIT. So the 116% you see here isn't correct. The 5-year growth rate is at minus 0.14%, which isn't a lot, but to be honest, I don't like to see a negative number here. They grew the dividends for 1 year in a row. And in their defense, they lowered the dividend during the lockdown periods, which was kinda a smart move to save some money there. So overall, an interesting looking dividend scorecard, where the dividend yield is very high and payout ratio is quite low. I would love to see some future growth, but that's something we have to wait on. Next up are the historical returns versus the S&P 500 and some competitors. I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include Kimco Realty and FRT. On the 5-year chart, we see that SPG had a minus 7.5% return including dividends, so this doesn't look very good. You are better off owning the S&P 500, which returned 55%. Kimco Realty returned 50%, while FRT returned minus 6%. On the 1-year chart, it's pretty much the same story. All stocks had a minus 15 to 17% return except for Kimco Realty. On the 6-month chart, it's getting quite interesting since SPG returned almost 25%, while the S&P 500 returned only 5%. On the 1-month chart, SPG returned nearly flat, while all other stocks returned minus 3.5 to minus 7%. Overall, I think SPG didn't perform very well on the 5-year chart with minus 7.5%, including dividends. But most recently it becomes more interesting. But does this mean that SPG stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth, I'm filling in minus 1% because of the analysis expectations and the historical averages. For the mid assumption, I'm filling in 1%. For the high assumption, I'm filling in 3%. For the profit margin, I'm filling in 36, 37 and 38%. For the free cash flow margin, I'm filling in 50, 54 and 58%. PE ratio isn't the correct metric to use for REITs, but we have to fill it in, so I'm putting in 15, 16 and 17. For the price to free cash flow, I'm putting in the same numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return owning an ETF. Right now SPG stock is at $117. I hit analyze and we see a lot of red numbers. I don't pay attention to the PE ratio since this isn't a great way to value a REIT, so I'm only focusing on the discounted cash flow value. We have a low price target of $75, a mid price target of $96, and we have a high price target of $123. To me, the low to mid price target is the most justified here, so that means that this stock is overvalued and that it needs to drop quite a lot to become an interesting buy. My final conclusion is that I see a lot of problems with this REIT. Revenue growth is expected to be nearly flat in the coming years, and that worries me a lot. Based on different numbers, the stock is overvalued and I don't think it's a buy right now. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.